Hey everyone, it's Andy Fulton, President of Sales of Future Home Loans. Welcome to this week's edition of Future You. We've got some really cool content just to talk about high-level economics in the housing market. And to help me talk about this, I've got Nate Jomaa joining me this week. We have no Andrea Dolan this week, but we do have the beautiful Nate Jomaa from Melbourne, Florida. Nate, say hello to everybody.
Hey everybody, Nate Jomaa, Vice President of Strategic Development here at Future Home Loans. And it is my pleasure to guest host with you today, Andy.
Thank you. It's late October, Nate. I'm up here in Nashville, North Carolina. The weather's starting to get cool. I'm wearing a hoodie today. How's the weather down in South Florida right now?
It's beautiful. It's a little bit chilly. It's in the 70s today. So we are seeing a little bit of a cold front come through, but all is good here in Melbourne.
Right on. Hey, Nate, I'm going to bring a couple visuals up that actually were sent out by Housing Wire this week, and I thought they were really important statistics that are visuals to help people understand kind of what's going on in the housing market and what to expect maybe in the next year. So first, let's look at this graph real quick. This is about a breakdown in the United States of homeowners of the categories of what interest rates do homeowners have right now. And if you look at the very bottom of this graph, you've got kind of a black part of the graph bars that shows 20.4% right here. And it's identifying 20.4% of homeowners have still an interest rate of under 3%. And we've been referring to the section of homeowners, 1 in every 5 homeowners has a really, really low interest rate, a historically low interest rate, as these are locked in homeowners. Nate, can you talk a little bit about what it means to be a locked-in homeowner from the perspective of how I'm sharing it?
Yeah, so a locked-in homeowner, they have a great rate on their home right now, and they might be a little bit apprehensive to do anything with that mortgage, whether it's refinance or sell the property and take on a new loan, knowing that their rate on the new house is probably going to be higher than the rate they have now. So even if they're downsizing in their house, they could potentially find that their mortgage payment due to the rate is a little bit higher. So they have some concerns about making that change.
Yeah, it's as you move into the different colors, bottom to top, it is less likely that these homeowners will be in a position where they want to sell their house and move, especially if they have to obtain a mortgage on a new home, because mortgages today are above 6%. These homeowners would experience some interest rate shock. They would nearly double their interest costs if they move. So unlikely, it's possible, but unlikely. You then move into some homeowners in the 4 to 5% interest rate category. Again, still probably in the unlikely category, but probably more likely than those under 3%, especially if they have large life changes. Maybe they're, like you said, downsizing and retiring, or maybe there's, a breakup of a family, maybe a separation or divorce going on. That probably causes more of this category of homeowners to need to make a move instead of want to make a move. What I would say, though, is I'm going to flip this upside down. I'm going to talk about the homeowners in this category right here, the homeowners that are basically above 5%. If you're above 5%, there's pretty good chance that if there's a desire to move, if you're looking to live closer to work, or move to a new location because you've got a new job opportunity for whatever reasons, right? Or even downsizing, you're going to be less impacted by, hey, I'm going to take on maybe a 6% rate or a 6.5% rate in this market. I might be leaving a 5.5% rate. Not as big of an impact. And in a T chart of what the advantages of moving might overcome any increase in interest costs. In fact, some of these homeowners, especially that are up towards the top here, could improve an interest rate in today's market because rates are down today compared to, let's say, a year ago. There's probably 4 or 5 small periods of time in the last 3 years where you could have probably been in that scenario where you bought a house and interest rates were elevated even compared to where they are today. So you could benefit from, even if you stayed home, you could refinance. The second thing I want to pull up, Nate, is I want to just talk about the building of equity in homes, right? And so what you're looking over here on the right side of the chart is it says the average equity in a home, which is the purple shaded part of the graph. I'm colorblind. I hope that's purple. Is that purple, Nate?
I'm colorblind.
Fair enough. There's 55.8% equity. Nate, just for somebody that may not understand what that means, can you just break that down in simple terms?
Yeah, so that means that homes out there right now have only about 40% of that, or 45% of that, that is principal owed on a loan. And the rest, meaning the rest of what that's eligible, or sorry, the rest meaning what they have in terms of the value of that home is equity that they can tap into. So they can use that equity for anything that they want to use it for. And then they can access some of that equity without touching their first mortgage, even by getting a home equity line or a home equity loan.
Right. So let's put it in really simple terms. If your home is worth $100,000, the average homeowner owes about $44,000 on a $100,000 value house.
Yep.
Right. So let's make it bigger. If you own $1 million house, the average person only owes about $440,000 of the $1 million value house. So you've got a lot of equity, like what you own in the house. If you were to sell it today, you would take about a little bit more than half of the value of the home and you would pocket that in cash. We've talked about this in previous Future Use. This is the predominant way to build wealth in the United States is home ownership, right? You don't have the ability to build equity if you're renting either an apartment or renting a house. It's 100% interest. When you own a home, even if you take a mortgage out on it, as time goes on, you build equity in two ways. You pay down small pieces of principal on every mortgage payment, which becomes larger and larger over the life of the loan. And then your house appreciates. Houses don't, it's not guaranteed that houses are going to appreciate every year. But over a long periods of time, if you look at 10, 15, 20-year stretch, the average home appreciates, and appreciation is going up. It used to be about 2.5%, 3% a year. It's about 3.5%, 4% a year average appreciation on homes right now. So that's building this equity, which is building net worth. And Nate, you talked about that. Like there's things you can do with equity. Let me just start with the simplest. If you're thinking about moving in the next year and you sell your home that has this kind of equity in it, that equity can represent a down payment for a new home. It can actually represent the amount of money you need to buy a new home, right? If you've been living in your home for a very long time, you've built up a lot of equity, you could sell your house today, even if it has a small mortgage on it, and it's enough money that you're going to get back in cash to pay it to buy a new house with cash. That happens a lot as well. But let's just say you're not thinking about moving. There are ways to access your, let's say maybe you want to upgrade your kitchen, you want to upgrade your bathrooms, you want to put a pool in, maybe like the house needs to be renovated. Maybe you got kids going to college. There's all these big life investments that might be coming up soon. How can you use the equity in your house, Nate, to pay for those things?
You can use the equity in your home to pay for those things by getting a home equity line of credit or a home equity loan, which, as I said, doesn't impact if you're in that 50% at the bottom of the previous graph, does not impact your first interest rate. So you can still continue to have that amazing interest rate, but still be able to utilize some of that equity that you have to take care of those short-term things that you want to look at.
Yeah, so taking out a home equity line of credit, even if you own your house free and clear, you can take one out. If you have a mortgage on your house, there's a limit to the amount of equity you can typically tap into. Usually, I think it's somewhere around 80%. But you could put a second mortgage on the house. That's a line of credit or a loan and access it. There's all kinds of different ways to structure that, and it's important that of all those programs, it fits exactly what you're looking for. Whether you're just looking for emergency funds or you really have a known need for that money. There's programs that are specific for that.
Exactly.
Hey, Nate, on top of all these statistics, we'll share one more. Nearly 40% of all homeowners do not have a mortgage anymore. The home is owned free and clear. I think that is a really, really important stat just in terms of the health of the economy. I mean, the economy is so much in the news. That part of that stat is good. That's good economic news for us because 40% of homeowners do not have a mortgage. That makes the cost of living very, very inexpensive. There's a massive difference of like haves and have-nots in homeownership. Successful homeownership for long periods of time, they end up creating this space where 40% of homeowners own their homes free and clear. It's such a different dichotomy for the experience of life in the United States right now compared to somebody that hasn't quite owned a home yet or is renting. Can you talk about, for the folks that own their homes free and clear, what the market's going to look like for them in the future if they're thinking about moving or making changes?
Yeah, so you have 100% equity in your property. So as Andy said, we expect that we're going to have appreciation year over year. So If you stay in that property for another 3, 4, 5 years, you're going to continue to have more equity that we talked about earlier. And then when you do sell that home, if you're going to move to a new home, if maybe you're going to sell that home and you're going to buy another home cash, whatever you're going to do, you're going to have 100% of that equity that you're going to be able to use for that move. So that's going to allow you not just to pay cash potentially for your new home, but to also eliminate any debt that you have. When you sell that house, that's your cash. So you can do with that cash whatever you opt to do. If you want to buy a home and make some improvements on it, you have cash to pay for it. So you're not putting yourself in debt. And then any improvements that you make to that home that you're buying, you're already improving the value on that property from day one.
Yeah. Yeah. You have a lot of options. If you own your home free and clear, again, 40% of homeowners own their home free and clear nowadays, which is a lot higher than it used to be, especially during the financial crisis 15 years ago. This is in my opinion, this is a real strong, healthy rebound from that time period. We still have some struggles here in terms of homeownership affordability and interest rates and the economy in general, but that part of the economy feels real healthy at the moment. Nate, I appreciate your time today. Hopefully this is helpful for people. We're just sharing information. If you need help with anything that relates to homeownership or attaining a mortgage or thinking about making a move, all you have to do is just email help@future.loans with whatever question you have, and we'll get connected with you as fast as we can. Thank you, Nate. Have a great day.